This is about practical tips for buying insurance. Today's topic is on directors and officers liability insurance. A D&O policy is an insurance of management liability. It generally consists of three types of cover for directors and officers, which are popularly known as Side A, Side B, and Side C. Side A typically covers liability for wrongful acts committed by the insured person in their capacity as directors and officers, where the company is unable to indemnify them. Side B covers directors and officers towards reimbursement to the company when the company has indemnified the insured persons in respect of claims made by them for wrongful acts committed by them in their capacity as directors and officers. Side C coverage is for the company itself for claims arising from wrongful acts associated with the offer, sale, purchase, or trading of its shares or securities. The D&O policies were introduced in the Indian market over 2 decades back. The wordings have considerably evolved since then, and a wide coverage is now standard offering by most insurers. However, a few important points must be kept in mind while buying a D&O policy. Firstly, the policy language is most important. One mistake that is commonly made in the purchase of a D&O insurance is that coverage is assumed to be available based on the coverage title rather than its content. Such assumptions need not necessarily be correct. For instance, D&O policies may provide a dedicated additional limit for directors, but one policy may cover all types of directors under this limit, whereas the other policy may cover only independent directors but not executive directors. Secondly, the selection of limits of indemnity needs careful consideration. Buying based on benchmarks with peers in the same industry can be misleading, as risk exposures can vary from one company to another. If overseas subsidiaries are to be covered with probability of foreign jurisdiction claims, then a higher limit of indemnity is required. Sometimes a combined indemnity limit for Side A, Side B, and Side C is taken. In such cases, an entity claim under Side C can erode or dilute the limits available under the policy for directors and officers for Side A and Side B. This must be kept in mind while buying combined limits. Thirdly, the selection of the insurance company is important. One must go for a carrier that has experience and capabilities for settling claims in foreign jurisdictions, for efficiently supporting the claim and arranging the defense if need be. So these are some of the critical points to be kept in mind. But certainly these are not the only ones. Like every other insurance purchase, one must carefully read the policy and understand the terms and conditions, particularly if there are any special conditions or warranties that are to be complied with by the insurer. Thank you.